Hey, what's going on, guys? It's Rupert here, and yes, you read the title right. In this video, I'm going to give you direct, undeniable, and historical data that's going to prove to us that the recession that's supposed to come is actually closer than we think. Now, the specific data that I'm talking about is called the inverted yield curve. Now, to make it easy, by the way, guys, I'm just going to use the interest rate hike chart. It's going to make it a lot easier, so it's going to be the same thing. It's really identical, but we're going to go with that in this video. So let's get into it. So guys, right off the bat, if you could actually do me a favor and subscribe and like the video, it really does help the channel. All right, so before I show you the chart, I'm going to explain to you what the chart even is and what can you expect to look at. It's very simple, so keep up. So this specific chart, the interest rate hike chart, is going to show you specific interest rate hikes over the past decades, and it's also going to show you when recessions happen. So the blue line is actually the interest rates going up, and the gray shaded area are the recessions that actually took place during that time. Now, what does this chart tell us? What does it tell us right off the bat? Like a naked eye, what can a naked eye see? Well, there's a spike, and every time there's a spike, a recession follows. And this didn't happen once. We're talking since 1955, it's been happening almost a century. But now you might be asking, hey, if the recessions happen when there's a spike in interest rates, why aren't we in a recession now? Why doesn't it hold up? Well, that's good logic, and that's a good question to ask. Let's look at the chart in more detail. Let's look at the last 3 recessions. I want you to notice something in there. If you look closely, the recession actually took place when the interest rates had started to go down. Very, very key information, guys. Not when it goes up, not when it stays up, only when it goes down. So be assured, I'll tell you right now, when our rates start to decrease, expect a recession. But now the burning question is, why? First of all, why is there a recession when the rates go down? They should be coming up when the rates go up, or then when they stay high. That's when everyone feels the pain, right? No. Let me explain. So the Federal Reserve, or the Fed, they use interest rates as a tool to control the economy. When the economy is heating up and inflation is getting too high, the Fed raises interest rates. This makes borrowing more expensive, which cools down spending and investments, right? Perfect. Think of it like this to make it easier. For example, your soup is boiling. You turn down the heat to cool things down. But again, when the economy cools down or slows down too much, then the Federal Reserve is actually going to cut down on the interest rates, which is obviously going to increase borrowing and spending in the economy. Think of it like this in the same example. Let's say your soup is getting way too cold. You got to increase the heat to make it go hotter. But here's the most important thing that I want you to understand. Well, let's use the same example. If, for example, the soup is boiling and you turn down the heat, the soup isn't going to cool down like this. It takes time. And the same goes for interest rates. Interest rates are lagging indicators. For example, if the Federal Reserve raises interest rates today, the effect of that raise is going to be felt next year. It takes time for it to be realized. And vice versa, same thing if it was to decrease today. Well, we're not going to realize the impacts of that decrease until next year. It takes time. So what happens is the Fed often starts cutting rates when they see signs that the economy is slowing down. But by the time that these rate cuts take effect, the economy pretty much is already into a recession, as we just saw in the chart. And again, another example of this would be like, for example, if you're trying to turn a big ship with those pirate movies, if you turn a big ship all the way 90 degrees, it's going to take time to actually turn. It takes time, and it's not instant. It's not right away. But now let's look back into that chart. You can see that in the early 1980s, the Fed raised rates to combat high inflation. Rates went up to around 19%. This slowed the economy down, and we ended up with recessions in the early and mid 80s. The Fed then cut rates to stimulate the economy, but the recessions were already underway. Why? Because the real effects of the total 19% interest rates were realized the year after it happened. Next, in the late 1980s and early 1990s, we see a similar pattern. Rates went up, they went down, and a recession followed. Fast forward to early 2000s, the dot-com bubble burst, the Fed cut rates, and we had a huge recession. Then in the mid-2000s, rate went up again, followed by the financial crisis of 2008. Again, very famous crisis right there, that one. The Fed slashed rates to near zero to help the economy sort of get a boost and sort of give it a stepping stone to really recover, but the recession had already hit. But now let's get to the topic what most people want to know. how does this affect us? How does this affect our situation now? What does this mean for you? Well, what this means is if the Federal Reserve raises interest rates so steeply and so highly in such short notice, we are going to have a recession. But again, I want you to keep in mind, it's not going to happen now. It's not going to happen next year. It depends on when the interest rates start to go down. So we have to pay more attention to what the Federal Reserve does. We have to look at when they're going to reduce their prices, because that's when the recession is going to happen. Fortunately, the Fed did put out their predictions, and they actually did tell us what each member of the Federal Reserve predicts the rates to be in the future. And if you notice here, most of them are signaling to a recession in the late 2024 into early 2025. Put in a year after that, and we're looking at a recession in roughly 2026. So guys, these are not made up numbers. These are not made up facts and made up data charts. This is real facts, real historical data that has not been tampered with. And if you want to look at it this way, it sort of tells a story on how the Federal Reserve interest rates and how the Federal Reserve decisions cause recessions, how their poor management of inflation, how their poor management of inflation control affects the economy. So again, because a recession is inevitable, I am going to make a video on what to do given that there is a recession, what you should do to put yourself in the best spot to recover, not only recover actually, to actually come back stronger than ever. And there's a lot of ways that people can do that. In fact, more millionaires are made out of recessions than any time. So it's a great video that I'm going to make following this one. So stay tuned for that as well. So for those of you who made it to the end, you right here, you're a real one. And I appreciate you. I notice you. And thank you so much. That's all I got to say to you. If you liked the video, comment down below on what you liked. And hey, give me suggestions. I'm open to everything. And thank you so much. Thank you for watching. Take care.